Hey guys, how you doing? A quick update from tax this time. The other day, this was last week, the Treasury released their proposed legislation for the CGT, another second batch of CGT changes they're putting through. If you have been watching the channel, you know that we're getting big changes to capital gains tax, biggest changes since they were introduced in 1985. And these changes have some pretty fundamental impacts about how CGT is being calculated. Okay, but these round of changes brought in one particular piece. It's an apportionment method for working out capital gains tax. So let me start at the beginning. Why is this important? Well, here's what's going to happen. 1st of July 2027, there is a deemed disposal of your assets and a deemed purchase for your assets at that date. So what does that mean? Well, it means that if you bought an asset this year, today, on the October 2026, and you still own it on 30 June or 1 July 2027, for tax purposes, you're deemed to have disposed it, and that will give you the discounted capital gain under the old rules, the current rules. If you've got a pre-85 asset, these are assets that were not currently subject to taxation. They also have a deemed disposal, no CGT in this case because it's a pre-85 asset, but it does set a benchmark at that point in time. Then from that date going forward, you then have the new rules applying, okay, which is the indexation of cost base. Now, I'm not going to go through what indexation means and how it works. Today's more focusing on that particular point in time and why it's so critical. So there's two methods proposed in the legislation for working out that value as at that date, okay? Because that's really, really critical. Because if you think about it for a second, your indexation will start at whatever level that is on that date and go up from there. Okay, or potentially even down from there if we've got deflationary, but let's hope we don't. It'll go up from there at that point in time. The old method, the old 50% discounts for individuals, will be for the date you bought the asset to the 1 July 2027 date. Okay, so you need a valuation. Well, how do you do that? There's two methods. The first method is allowing you to go out and get a valuation, a proper valuation. Now, for some assets, that'll be easy. If it's listed shares, traded things like that, there'll be a valuation on that date, and that will be the value on that date. Okay, so Telstra shares, your BHP shares, anything listed on a stock exchange, currencies that are caught by CGT, gold. If you've got gold, for example, what's the price on that date? That'll be pretty simple to see. For other assets, like a business or property, that's incredibly difficult. And you might need to go out and actually get a proper valuation done by a proper valuer who has the requisite skills to sign off on what that thing is worth. No doubt this will be litigated through the courts for decades to come because the ATO, there will be massive differences in valuations. That doesn't mean you have to go and get one at that date necessarily, but the longer you leave it from 30 June, 1 July next year, sometimes the harder it is to actually, the data vanishes, the harder it is to actually value that thing as at that date. So, we're looking mid next year here for a proper valuation. That costs. Valuations of cells are not cheap. They could start in the low, you can easily start at $10,000 and go up from there, depending on the size and difficulty of the business. So it's not a cheap exercise to do. That's number one. However, Treasury in the government, bless them, have also allowed a different methodology. Now, what the methodology says basically, and this is proposed legislation, it hasn't gone through Parliament yet, is you've got the start date of the asset, the 1 July date, and the date you sell the asset. And it takes an apportionment from there to there, effectively just on a day's basis. So if you've got this much at 30 June, before 30 June 2027, and this much afterwards, let's call that 1/3, 2/3, you'll have 1/3 under the old method and 2/3 under the new method. Okay, that might be a reasonable way of doing things. It could give you a fairly good number, and it's fairly. Yes, obviously costs you nothing to do. You can work it out. The methodology is a little hard. There's like 9 steps, and I've been through them, and it gets very easy to get confused. And in fact, it's so difficult. Treasury themselves made a mistake in their the documentation that came out with the legislation. So this is not easy stuff. Okay. Now, where it falls down though is if a business has grown rapidly here, to 30 June and then done that, then you're going to end up with this part, which is the rapid growth bit, being taxed more heavily effectively than the bit afterwards. Okay, so it won't suit everybody in all circumstances. It's absolutely going to be one of the things we've got to look at the time when, if we're planning a capital gains tax event, what does that growth look like? If you had a business that did this and then up, maybe that works. I don't know. But most small businesses and most growing businesses tend to sort of do parabolic growth at the start and then level off as they get bigger. That's just it's a natural growth for firms. So absolutely, it's a case of watch this spot. We will bring you more as legislation passes through Parliament and as these technical changes come through. Till next time, cheers.